Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Waitr's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Waitr is a store-to-door delivery service. In addition to that, another service it offers is when you're sitting at a table in a restaurant, you can take a picture of a QR code with your phone. Then you'll be redirected to an app with the restaurant's menu so you can order food and drinks. This helps the manager of the restaurant because they can manage things a lot more efficiently. The restaurant saves money on payroll because less waiters or waitresses are needed. They also have 3 apps called Waitr, Delivery Dudes, and Bite Squad. You can order food or almost anything from various businesses and have it delivered to your home or work. Restaurants and different stores would register with these apps to be part of their delivery network. If you want to buy groceries or alcohol from a grocery store, you can do that through the app as well. It recently started delivering cannabis. There is a lot of competition in this space like Uber Eats, Grubhub, and DoorDash. Also, many restaurants or food chains like Domino's have their own food delivery app already. If a business is looking to increase revenue, it could be beneficial to be on as many different apps as possible. If a store has enough demand already, then it would not want to join Waitr and give away some of its revenue to them. In 2018, the company was acquired by a SPAC for $308 million. It was called Lancadia Holdings. Later that year, Waitr acquired Minneapolis-based Bite Squad for $321 million. 2019 was a tough year for this company, so they revamped the executive team. The founder and CEO stepped aside as well as the CFO. The former CEO of iPayment became the new CEO of this company. The first thing he did was exit 70 markets the company was not profitable in. He focused on 700 small and medium-sized markets that were more profitable. Waitr cannot compete with big companies like Uber Eats and Grubhub in large cities, so their focus is in smaller rural areas with less competition. The second thing the new CEO did was lay off all of its drivers and move to a contract-only model similar to Grubhub and DoorDash. Now they have independent contractors instead of W-2 employees, which saved them a lot of money. The company is headquartered in Lafayette, Louisiana, and was founded in 2014. It trades on the Nasdaq, Deutsche Börse, and Börse Stuttgart. Let's get started with the model. This is a micro-cap company, 103 million market cap. They're trading at 86 cents a share, and they have 120 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have negative free cash flow in 18 and 19, but finally had positive in 2020 and also in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's only positive in 2020, negative in the other years. Revenue is the sales for the company, and that grew a lot from 18 and 19, pretty consistent after that. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. You can see with similar revenue as 2019, 2020, and the trailing 12 months, they really lowered their cost of revenue. It was 148 million, down to 109 million and 113 million. So they have a much higher gross profit, and below that is their operating expenses. Their revenue was 13 million higher in 2020 and 8 million higher in the trailing 12 months when compared to 2019. But they really reduced their operating expenses, 133 million down to 68 million, 74 million. So the CEO did a great job in improving the company's margins. It's not only about revenue, profitability is just as important. They finally had positive operating income, 27 million in 2020, 12 million in the trailing 12 months. Now they figured out the formula for profitability. Now they just need to scale that and add more cities to their platform. They do have a bit of interest on their debt, so they paid 7.6 million of interest in the trailing 12 months. And the bottom line of the income statement is their net income, which is negative every year except in 2020. The only reason they had a big negative in 2019 was due to large goodwill and asset impairments. I would just focus on operating income when I look at the income statement. The things below that can really skew the numbers. Here's a breakdown of their 2019 and 2020 expenses. With 13 million more of revenue in 2020 when compared to 2019, their expenses decreased in every single category. Operations and support 148 million to 109 million. Sales and marketing 52 million to 12 million. R&D 8 million to 4 million. G&A 57 million to 43 million. Depreciation and amortization 16 million to 8 million. And the reason they had a big negative net income was due to this large goodwill impairment and this asset impairment. Goodwill impairment is the write-down of an asset this year because you overpaid for a company in the past. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. So they do have positive operating cash flow now due to the CEO's smart decisions. Then you have capital expenditures, which are investments in property, plant, and equipment. In the company's annual report, they talk about their CapEx expenses. They talk about purchase of tablets to put on the tables in restaurants. Some people may not bring their smartphone into the restaurant. And CapEx is also for the development of the food delivery platforms. Operating cash flow minus CapEx gives you your free cash flow. And that was negative in 2018 and 19, positive in 2020 and the trailing 12 months. They use equity and debt to run their business. They issued 50 million of equity in 2019, 48 million in 2020, and 25 million in the trailing 12 months. They also use debt. They issued 93 million in 2018, 50 million in 2019. They reduced their debt load in 2020 and the trailing 12 months. This is the equity section of their balance sheet. They have 93 million of equity. They raised 466 million from selling their business, and they lost 373 million from running their business. Let's look at the capital structure. 93 million of equity, 92 million of debt. So they're 50% equity, 50% debt. The highest WACC according to Finbox was 12.8%. So I used that WACC to be more conservative, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 255 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $233 million. We divide that by 120 million shares. And we get a calculated stock price of $194. They're trading at 86 cents, so they're trading at a 56% discount. It's a strong buy according to the model. The average analyst projects their revenue to grow 1%. So I grew their revenue 1% for the next 4 years. To get their future free cash flows, I needed to see what percent of their revenue they convert to free cash flows. So I summed up these two free cash flow numbers, that's 50. I divided by these two revenue numbers, that's 404. 50 over 404 equals 12%. So I multiplied these revenue numbers by 12%. That's how I got that future free cash flows. And you can see I'm coming out with a stock price a lot higher than they're trading at. If I did a video on this company a few months ago, the stock would have been overvalued, but it came down so much, it seems like it's an undervalued stock now. Of course, any penny stock is really risky. Much riskier than investing in a company with a 100 billion market cap. But I think this is a great acquisition target for a bigger company like Grubhub or Uber Eats. A faster way for those companies to get into smaller markets is just to acquire this company, then try to set up in a smaller market and wait for customers to use their service. It just takes time. Just because you're popular in a place like New York City doesn't mean you're automatically popular in a place like Buffalo, New York. So the market really doesn't like this stock. They keep pushing the price lower and lower. And I think the company is doing a great job. So if anything, the stock price should be going up, but it's going down instead. Simply Wall Street is higher than me. They're at $239 a share. They're saying the stock is 57% undervalued. One analyst priced this stock and their price target was $1.80. And they have a negative beta, so the stock moves opposite the market. The stock has gone down 63% in the past 52 weeks, while the S&P went up 25%. The 52-week low was 80 cents, so it's really close to the 52-week low, and the high was 457. And the stock is trading below its 50-day and 200-day moving average. This is a really popular stock. 24 million shares have been traded on average the past 10 days. Of the 120 million shares outstanding, 104 million are on float. 33% are held by institutions. And a lot of people are shorting this stock. Their short percentage is 19%. This is the short percentage the last year. It was 7% last year. Then it grew to 14%. It came down to 10%. Then it went way up there to 17%. Even though the stock price is trading pretty low, I'm surprised the short percentage is so high. So you can see in 2019 they had 22,000 employees. So that's why they're saving so much money now. Their employee count is much lower. It's just mainly people in the operations team. The biggest shareholder is Portoland Capital of 5%. Tillman Fertitta, who owns Lancadia Holdings, the SPAC. He also had a TV show that I watched where he would go to different companies and see if they could become vendors for his businesses. The founder of Waitr owns 4%, Vanguard and Jefferies. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a really good price to sales ratio. It's 0.5. That means their revenue is twice their market cap. If you just look at the price to sales ratio, it does appear the company is really undervalued. And they have a good price to book of 1.1. They do have negative tangible equity since they have a lot of intangible assets on their balance sheet from all the acquisitions they've done. They have a decent return on invested capital of 8%, interest coverage ratio of 1.6. They have a negative ROE, a good current ratio and quick ratio, 1.6. They have a good amount of cash on their balance sheet, $60 million. So the company does seem to be well capitalized. They had $17 million of free cash flow in the trailing 12 months, $27 million of working capital. So they have $44 million of funding. So it looks like they can get through the next 12 months without adding any debt or equity. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 36 companies in the same industry as Waitr. And Waitr has a really good price to sales and price to book. Their current ratio is fine. Negative ROE. The average in this industry is negative because so many companies have losses. Their debt is a little high at 50%. The average is 27%. And they're a tiny company, 100 million market cap. The average is 28 billion. So to summarize, I have them trading at a 56% discount. A lot of people have been looking down on SPACs lately because of their underperformance. But this company seems to be doing a lot better. If they continue on this path, they could be really profitable. I think they're a great acquisition target, and if they get acquired, your stock should go up 50% overnight. It's smart they're focusing on smaller cities with less competition from bigger food delivery companies. I think it's important to have a niche. No matter what business you're in, you should have some type of niche. I rank their free cash flows 5 out of 10, their revenue 6 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.